It seems I was muted. I suppose is the motto for 2020. Please welcome everyone to the seminar today. Just going to be doing a brief overview of our current investment outlook, talking about what's happening globally, some insights into the elections and what happened in the markets in September. Please, I'd like to encourage you to ask as many questions as you want. Just click on the chat in the Q&A section and ask a question. I'll get to them. Hopefully there are lots of questions and we can have a somewhat interactive discussion. I'm going to start right off just with what's going on in the markets. So if we can go to the presentation, please. So on Monday we had our fixed income investment meeting. Happens every month, and Tuesday was our asset allocation meeting in Ashburton. So let's just start off with where we are at the moment. It always helps just to quickly put the various numbers in context. Currently, the US dollar is trading about 16.50 to the rand. The euro is about 19.50, and the Great British Pound is 21.50. The SA 10-year, which is not really a specific bond. It's an interpolated point or a midway point between two different bonds. On the one side, you've got the R2030, which is now a 9.5-year bond. And on the other side, you've got your 213, which is a 10.5-year bond. And the point between them is the 10-year, and it's sitting about 9.7. That's actually a little bit above the 30 and 100-day and 200-day moving averages. The same is not quite the case for the US 10-year. You can see that the US 10-year has been trading broadly in a range. Brent crude has now been around $42 a barrel for a while, and has been trading in that range as well. Gold is off its strong point from 2,000 back to 1,900, and Bitcoin's had a very good year, continuing to rally now at $11,000. So if we look at just some of the performances for various asset classes up until last week Friday, the first thing we'll notice is that September's not really been a good month for SA asset classes, right? If you look there, bonds are down 80 basis points, linkers are down 1.4%, preference shares are down 60 basis points, property down 4.5%, equities up slightly 20 basis points, but lagging cash. And it's actually only global property and global equity here that's up. And if you invested maybe a little bit in the rand, but this was last week, and we're already back again at 16.50. So it's basically flat now for a while. So from all the various multiple asset classes, it's only actually cash that had a decent month this month or last month to end off the quarter. And if you look further back to a 12-month period, their bonds have had a decent run. It's up 6%, or bonds are 2%, money market 6%. Going back to 36 months, you've got bonds at 7.5%. So over longer term periods, bonds are still looking good. Property is looking disastrous now. 24% down year on year, 3 years in a row. And globally, if you look at both US equities, as well as global bonds over 2 years and 3 years have had decent performance numbers. So I showed this chart last month as well, and I think it's a short chart we're going to show for a while. What it does is it just shows which asset classes are performing and how they're performing relative to cash. So on this chart, probably the most important one for most South African investors is equities. This is this green line running across there. You'll see effectively from 2014 to February 2018, cash was effectively in line with equities. They've actually performed pretty much in line. Then from February 2018 to February 2020 and up until now, we've seen this trend where cash has actually been outperforming equities. So going on now 2.5 years, cash has been steadily outperforming equities. And if you go back to pretty close to February 2014, cash has now been outperforming equities for over 5.5 years. That is one of the reasons why flows have been moving away from equity funds, to some degree away from balanced funds as well, and certainly from other portfolios that take a significant portion of their return expectations come from from equity risk premium. The other thing we also can notice is how properties had a similar pattern, just significantly more pronounced. Actually, the only asset classes that up until February this year were outperforming cash was bonds, and you had preference shares. To move a little bit ahead, inflation is a hot topic at the moment. Yesterday, Goldman Sachs came out and lowered their inflation forecast. They now have an inflation forecast for 2021 of below 3%. This was mostly on the back of several medical aids coming out and saying that their rate rises are going to be subdued. That is also likely to impact our inflation forecasts. In the next couple of weeks, we'll be updating our inflation numbers as well. And next month, which is November, we'll be giving our updated and consolidated inflation views for next year. Broadly, however, our view remains consistent with last month, that inflation is likely to continue to surprise on the downside. Last month I showed various banks, and this light turquoise line being the FNB house view on inflation. You can see it's lower than many of our peers. So broadly, that remains a core view for us, that we expect inflation to surprise and continue to surprise on the downside and be low. And that's likely to mean that interest rates in South Africa is likely to remain low as well. At the moment, the first round house view is that roughly one more rate cut can be expected in the next, say, 12 to 18 months. Contrast that once again with the Goldman Sachs view, which was just updated from 2 cuts to 3 further cuts in South Africa towards the end of next year. Regardless of whether it's no cut, 1 cut, 2 cuts, or 3 cuts, interest rates are going to be historically low, at least until the middle to end of next year, barring significant surprises in inflation, which, given the current global outlook, looks very unlikely. That means that money market funds and enhanced yield funds like Ashburton Money Market and Ashburton Stable Income will continue to outperform both inflation and cash and bank accounts, but will underperform those types of funds that can give you returns or source returns from different areas. Right? For example, the Ashburton SA Income Fund can invest in bonds alongside credit, and Ashburton Diversified can invest in credit, cash, bonds, property, preference shares, and offshore. So let's look a little bit at what's going on around the globe. We have a new global strategist, Jared, just started this month. He's put together a couple of slides for us. Let's first look a little bit at US politics. At the moment, most polling and betting is in favor of what's being termed a blue wave. Effectively, the Democrats winning relatively strong by decent margins, both in the presidential election and in the House and in Congress and in Senate. If you look at the polling averages in the 2020 here on the left-hand side, you can see that effectively since May, Biden has been polling stronger and stronger. And recently we've seen a spike. And some of that has to do with also with the debate performances, but also just the way Trump has now also gotten the coronavirus, even though he told everyone for months that it was a hoax and etc. If you look at betting averages, you can see that's expanded significantly as well. That was actually pretty close right up until almost the start of September, right? It's only really since then that it started to diverge, and betting is now sitting at 65% for Biden and 35% for Donald Trump. To compare that to 2016, because most of us, I think, are still a little bit scared of polling, given the disastrous polling outcomes in 2016, we can see that Hillary Clinton was leading by about 4 or 5 points in 2016. Biden's leading by about 10 points at the moment. I still think that the election is probably going to be closer than people think. There are some other underlying issues that does make the election a risk event. One of them is that the importance of mail-in balloting has significantly increased. And by a significant margin, Democrats are more likely to vote by mail-in ballot, whereas Republicans are more likely to vote in person. What that means is that it is likely that Donald Trump's numbers are going to look very good early in the day and then progressively get worse as more mail-in ballots get counted. But it takes a little bit longer than one day to properly account for mail-in ballots, which means that you could get close to the end of the day and President Trump could declare victory, even though he didn't necessarily win. Add to that the complications around the Supreme Court. If this gets disputed and taken to the Supreme Court, the outcomes can be quite challenging, and it's difficult to foresee what happens in those cases. The other important thing just to note is that depending on what news you watch, whether it's CNN or Fox News or MSNBC, or if you get most of your news online, either Biden is amazing and Trump is terrible, or Trump is the best thing since sliced bread and Biden is a socialist and a communist. In practice, on a policy basis, if you ignore the rhetoric and you just look at the types of policies that they've implemented or are likely to implement, there are some significant differences between them, but there are actually quite a few similarities as well. They both are likely to run pretty big deficits into the next couple of years. Both are likely to be tough on China. And both say that they're in favor of big infrastructure spend. When it starts coming to labor and healthcare, Joe Biden is more liberal. But in general, he is not a socialist or a communist. He was the vice president of President Obama, and we have to remember that many of the fiscal policies enacted under the Obama era were actually quite favorable to corporate, saving banks, saving American auto, making Bush tax cuts permanent. So he was, even though the narrative in the U.S. and among some of the media is that he's very, very socialist, in practice the Democrats are liberal with social values, but they tend to be far more conservative than people think when it comes to fiscal and economic values, with some obvious exceptions in that party. If you look at global PMIs, Purchasing Manager Index, you can see there was a sharp drop-off for China towards the end of last year, and for the US and the Eurozone towards April this year. But actually, most of them have recovered. Japan is still trading below, but all three of the other major areas are back above 50. If you look at global inflation, same thing. We saw a trough in global inflation there in about May, but with the exception of the Eurozone, you have most of the other regions seeing inflation rising slightly. One of our concerns is the significant rising debt burden globally, both in the US and in the Eurozone and in Japan. This chart on the left-hand side is not updated for the significant spike in global debt. We can see how sharp it rose in 2008, and we know that the recent spike that we've seen dwarfs the moves in 2008. One of the other things that's currently a concern is the number of zombie companies on the S&P 500. Now, as you can see there in the note, a zombie company is a company where interest expense is higher than free cash flow. What that means is that even when interest rates are as low as they are, these companies are actually living off continued debt issuance rather than continued profitability and growth. And that increases in the interest rates, right, both at the bond curve and at the Fed's fund rates, would mean that these companies won't be able to refinance their debt as easily, and they would go bankrupt. One of the reasons that it's expected that the U.S. will maintain interest rates and bonds as low as they are is because of this characteristic of the market. If interest rates are allowed to increase too much, several corporates are going to go bust. Now, it's important to realize now that this fear or this total aversion to corporate bankruptcy is not necessarily a good one for the long-term global growth of the economy, because the economy to keep on growing needs certain companies to fail, right? There's a term in economics called creative destruction, whereby old, inefficient companies go bust and they get replaced by better, more efficient, more creative companies. You need that kind of company churn. What we're trying to avoid is a situation where all of these companies go bust at once. But in general, you want these zombie companies to reduce over time. So just go to the next slide. So this is a chart on the central bank balance sheet as a percentage of GDP. You can see how that's spiked now recently. Bank of Japan is way ahead with 120% of GDP as central bank balance sheet. Federal Reserve saw a significant increase, but as did the ECB. This as well, you can see, is one of the trends that's relatively well known, is the increase in e-commerce sales as a total percentage of retail sales. That's this chart on the top left-hand side. You can see it's been steadily increasing over time, and it's jumped significantly now recently. Now, that number is probably a little bit overinflated because both e-commerce sales jumped, but also total retail sales fell. So it's probably slightly overinflated. But in general, that trend and the fact that the COVID crisis accelerated that trend is certainly two facts that are most likely indisputable. If we look at the last 6 months in the U.S. bond market, we'll see that the U.S. bond market has continued to trade in a relatively narrow band. That's 0.6% and that's 0.8%. And with the exception of a couple of days in June and a couple of days in July, effectively since the end of March, US 10-year has been stuck in this band between 0.6 and 0.8%. Now, it's important to note that this number, right, is actually below the expected rate of inflation. And we know that because if we look at the next chart, we can see that this is 10-year TIPS, the 10-year Treasury Inflation Protected Securities. It's the US version of an ILB, an inflation-linked bond. And the current real yield on a US 10-year bond, 10-year TIPS bond, is negative 0.9%, right? It actually bottomed out at negative 1.1%, which seems to indicate, if you take that number and combine it with the current 10-year number, that the inflation expectation in the US is somewhere in the order of 2% over the next 10 years. Now, we know that these markets are somewhat manipulated. So we know that these mechanisms and these calculations are probably less accurate than we would like them to be, but it's still a pretty good indication of where the market thinks inflation is likely to be going forward, or where at least long-term inflation is likely to trend. If you look at this chart, what you see is a range of emerging market currencies, right? This green line right there is South African Rand. That peak was in early April. And you can see the line above it is Brazil. This line there is Poland. And this pink line that's been trending there recently, that's Turkey. With the exception of Turkey, which has been trending quite significantly weak over the last couple of months, all the general emerging market currencies that saw a lot of volatility between February and April are all trading at least a little bit stronger than they were at their weakest. Now, part of that is dollar weakness, But we can see even now there still remains significant volatility in all of these various currencies. So what does our local bond market look like, and how does it compare to our peers? On this chart, what we do is we take the current real 10-year bond yield. In other words, we just take the 10-year bond yield, that number you saw earlier, that said 9.7%, and we subtract the current inflation rate, which at the moment in South Africa, at the last announcement, was 3.1%, and you get this number, a real yield of 6.6%, right? We plot that on two axes, and one axis is the budget deficit number, and the other axis is the current account number. And we do the same for all of our peers, right? And you'll see there, Brazil has a real yield of 4.8, Colombia is at 3.7, Ukraine is there at 5.3, Indonesia is there at 5.45. South Africa has about a 1% real yield gap with most of these countries, which is one of the reasons we feel that the bonds do offer some value, right? Now, take into account that it is still important to note that it pays up for the degree of risk that you're taking. This line, right, is likely to move to here. We expect South Africa's budget deficit number to come in February in the 14.5% to 15% range. So South Africa is risky compared to many of its peers. Our perspective is that you are being paid up or rewarded for that risk, particularly more at the front end of the curve than towards the back. If you look at the long-term history of the Rand, you can see here how in each prior crisis, right, the Rand weakens significantly and then strengthens over the next couple of years. Again, weakens and then strengthens, weakens and strengthens. Now, it's important to note a couple of things. Firstly, each strengthening period is slightly weaker than the previous one, right? We currently expect that the Rand, which is trading at 1650, will be somewhere in the 1550 to 1650 range at the end of next year. That sounds quite wide. 1 Rand on 15 Rand, however, is less than 8% range. The fact that the numbers are getting quite big makes a 1 Rand range sound deceptively wide. If we just quickly look at credit, September was a little bit of a difficult month, as I said, in a range of asset classes. Part of that was fears around the US election. Part of it was slight increases in the numbers globally around coronavirus cases and deaths. Part of it in South Africa specific was bad news around SAA. And what we saw, at least in a couple of cases, is that from the middle of last month towards the end of last month, you'll see that global spreads spiked. For example, SA CDS spread went from about 280 to pretty close to 325. And since then, it's actually come back down again, but that's mostly happened at the start of October rather than rather towards the end of September. And that pattern is broadly consistent. You can see here in investment grade in Europe, there was this little spike there in September. If you look at high yield spreads in Europe, you'll see that there was an increase in spread towards the end of last month. Same thing in high yield spreads in the USA. But in all of these cases, they've actually retracted and come back to where they started September, with a lot of the risk now at least most of that risk now being priced out of the market. It's important here to note that the VIX, the US Volatility Index, has remained stubbornly higher than normal, or at least higher than the average we got used to in 2018 and 2019. It's trading around about 25. It went up quite a bit higher than that a while ago. I think I do have a chart coming in here a little bit later of that. But the VIX has maintained a relatively elevated position, indicating that there is still quite a bit of risk being priced into the market, but options and optionality is still quite expensive. Okay, so let's look at the credit market. Now, the credit market is where Ashburton Stable Income primarily gets its returns and assets from. And when I say that, I mean the broad credit market, which includes the bank credit market. These are the auctions that happened in September. You'll see, for example, that Mercedes-Benz went to auction, Standard Bank, Denel, Netcare, and this one at the bottom is BNP Paribas. That's an offshore bank. It's rated a couple of notches above the South African sovereign. You can see here at what rate these various instruments cleared. For example, Mercedes-Benz issued paper in 1 year, right, at JIBAR plus 79. Now, JIBAR is around about 3.3, so that instrument pays you about 4.1%. You'll see BNP Paribas in 3 year cleared at JIBAR plus 155. Once again, 3.3 plus 155 gives you 4.9 approximately. It's important to note in this case that that is rated AAA, and that FirstRand also raises money in the NCD market in 3 years, and that the banks are currently paying about 50 basis points. In other words, 100 basis points less than this. At the moment in the market, Ashburton Stable Income, as well as some of the other portfolios, are starting to carefully reaccumulate some credit. We're being very selective in it, but these are the types of opportunities where you can pick up AAA rated credit. BNP Paribas, I think, is rated 3 or 4 notches above the sovereign. So the SA sovereign is rated, SA is rated AAA, but offshore is rated double B plus. And BNP Paribas is rated A minus. So it's about 4 or 5 notches rated above the sovereign. And you're paying up 100 points extra above something in South Africa that's rated 2 notches below the sovereign. So it is a nice opportunity. We picked up some debt there. If you look at the credit market in general, this is just a long-term spread chart. What you'll see is that we've seen credit contraction now for the last couple of years. For example, you'll see bank additional tier 1 debt. Just as a reminder, additional tier 1 debt, or bank AT1, is a debt instrument with a ranking similar to preference shares. So if you think about the traditional bank's capital structure, you have depositors at the top, then you've got senior unsecured debt, then you've got subordinated debt, then you've got preference shares and AT1 debt, and then you've got equity. So that's what a bank's capital structure looks like. You can see that in March and April, you saw the spike in spreads, but some of that's actually started coming back down again. To contrast that, this gray line there is SOE debt. And you can see that spiked upwards over the last couple of months and has continued to slowly drift higher. Corporate SA, unsecured debt, is this blue line there. And it's remained broadly flat at about JIBAR plus 200. The point is that credit spreads are now at the highest level that they've been in a while. And if you can pick up debt selectively, it'll help the fund perform well for the next couple of years, because these instruments are 3-year, 4-year, 5-year instruments, and hence will add to your return for the next 3, 4, 5 years. From a bank safety perspective, Bloomberg has a model on the site, on the tool, which calculates a 1-year probability of default for any listed corporate. Here we've looked at the big 4 South African banks. And you can see here's FirstRand's 1-year probability of default. FirstRand consistently shows the lowest probability of default of the big 5 South African banks. followed then by Standard Bank and Nedbank and Absa in the next cluster. So if there is, from a transactional or a fixed deposit point of view, FirstRand consistently shows up as safer as the other big banking peers in SA. From a bond perspective, one of the metrics we measure South Africa's bond yield on is to just compare SA's 10-year bond yield with the US 10-year bond yield. So if you look at these lines, this white line here is SA's 10-year bond yield. You can see the spike, the recovery, and the recent trend. And same thing here. This is the US 10-year. You can see the rally down now. And this line at the bottom, this area chart, shows the differential, the gap between these two. And you can see that we've actually now been sitting at this level of about 9% for at least the last 3-4 months. In other words, if you look at, just do the math again, our 10-year bond is currently yielding 9.7. Their 10-year bond is currently trading about 0.7. So the gap between the two bonds is about 9%. That is likely to remain unchanged in the near future. Only once the risk-on environment starts re-emerging, when global investors really start becoming hungry for yield, is it likely that we'll see significant flows again, and then we can see that number contracting somewhat. This is a chart which gives you a good idea of the relative value of two of the primary asset classes in South Africa. Once again, this white line there is SA's 10-year bond yield. And you can see how that's kind of stayed flat and up and down over time. The orange line below that is South Africa's 1-year NCD rate, right? And once again, this line at the bottom is the gap between them. You can see here in 2016, there was no gap, no difference between a 1-year NCD and a 10-year bond. In March 2018 as well, that gap was tiny. Since then, it's actually trended up slowly but surely. But now in March, there's been this massive spike. That spike was driven by two primary factors: significant cuts in front-end rates in South Africa and a significant deterioration in the fiscal metrics in South Africa. And what we can see now is, while this peaked in March, it recovered slightly. It's actually continued wider over the last couple of weeks and months. And we're now trading at the steepest that we've ever traded at. What that means is that the reward that you're getting for investing in a 10-year bond rather than in a 1-year NCD, the additional reward for the risk you're taking is the most or the highest that it's ever been. If you look at a similar type of chart, just the gap between the 5-year bond, right, and the 20-year bond, this is a measure of what's called the steepness of the curve, right? How steep is the curve? How much more are you being paid for taking longer-term 20-year SA bond risk compared to 5-year SA bond risk? Now, you have to take into account, this is the same credit counterparty with the same liquidity, right? Tradable in the same amounts with the same counterparties. So the two risks that you're taking is duration risk and term risk. And increased term risk comes with, implies increased credit risk, right? At least over time. And you'll see here that once again, this has been slowly but surely increasing over time, but we've seen this massive pickup since the end of last year and start of this year. And once again, we are trading at the highest level that we ever have been trading. This indicates a preference for shorter-term South African bonds, and it indicates that people still feel that you're not being rewarded enough for taking long-term SA risk. Now, some people may agree or disagree. We tend to prefer bonds out to about 2035, so not quite 15 years. Beyond that point, we feel it starts becoming a little bit that you're not being rewarded enough for it. So we're not totally averse to taking some medium-term SA risk, but beyond the 15-year point, we don't feel valuation support the higher yields that you would need. Okay, so let's look at another metric quickly. If we compare our SA-CDS, 5-year SA-CDS credit default swap versus the JP Morgan Emerging Market Bond Index spread, all we do is we're taking, this is the South African line is the white line here at the bottom, and the EMBI is the orange line. And all we're doing is just saying, what is the white number divided by the orange number? And then we get a ratio. How risky are we being evaluated or seen compared to other emerging market peers? And you'll see now the numbers we're trading at now is pretty similar to the numbers we're trading at during Nenegate and the numbers we're trading at pretty close to the peak of the 2008 economic crisis. Now, it's important to remember over this time, we've lost quite a few notches in credit rating, so we have become more risky versus our peers. So this current valuation now might be more justified than it was in 2016, but everyone has seen deterioration in fiscal metrics, not just us. So I still think that this relatively weak valuation gives us a degree of safety when investing in SA debt securities. Let's look at what happened over the last month just in the bond curve. This is the bond curve on the green line is the bond curve on, let me just quickly get that date, on Monday, whereas that little almost brown line is the bond curve at the start of September. And what you'll see is that at the front end of the curve, your 6 months, 9 months, 12 months area, your 6 years, that's your R186. Your front end of the curve has remained actually very well anchored. Even if the rest of the bond curve sold off between 30 points, right? So your 10-year point sold off 35 points, and your 15-year and 20-year point sold off just about 50 points. What you'll see is that the front end actually remained very well anchored. That's one of the reasons we like some of the bonds at the front end is the low interest rates and low inflation at the front end of the curve helps to anchor the bonds here, whereas your longer term bonds don't necessarily have that same degree of anchoring. Okay. I still haven't seen any questions come through. Let me just see if there's another chat here. No. So this is the model that we built to give us an idea of what we think bonds can do in the next 12 months. Right? Because we must remember that bonds get return from initial yield and from rolling down the curve. In other words, becoming shorter dated. A 5-year bond has a higher yield than a 4-year bond. So when your 5-year bond, if you hold it for a year, effectively the exit yield you expect it to be lower, and that is called roll down. So if you look here, you can see that given a couple of calculations and metrics, we expect that the bonds here at the front end of the curve from about 2030 to about 2037 are your highest return bonds, giving you between 12.5% and 14.5%, right? With the exception of the R209 right there, which is actually between the 35s and the 36s, right? So if you look here, the R209 has a higher maturity, longer term maturity than the R2035s, but the yield of the 35s is actually better than the 209s. So we don't like the 209s in that space. If you look at that, those are the highest return bonds, with the 2035s showing us, according to our model, giving the highest prospective 1-year return expectations. right? Now, we also do a calculation. What happens if the yield curve goes up by 50 basis points, and what happens if the yield curve goes down by 50 basis points? Right? Then those are the return numbers we expect. We also take into account duration, and when you do that, right, you'll see here that these bonds, up until the 35s, offer you your best prospective returns. And they all offer you relatively the same kind of duration return, or return adjusted above cash. So we've got a number there, 3.46. That's the 1-year NCD rate. We subtract the expected return. We divide it by the average duration, and we get those numbers. So depending on where on the curve you kind of want to be, this R186 to the R2035 section is most likely the best place for 1 to 2 year holding periods. Okay, let's just quickly talk about inflation-linked bonds. Linkers, as you recall, sold off in September. But if you look until the end of September, year to date, your front-end linkers up to the 2029s had positive performance, and your back-end linkers had negative performance. And the more front-end you are, the better the performance numbers were. Over the last 3 months, most of your linkers at the front end gave you around about 2.3 to 2.8%. Your I-2025 is giving you 4%, 4.7. This is even taking into account how high some of the linker yields still are, right? So let's just quickly go there. This chart is a chart of the inflation-linked bond yield in South Africa. And you can see here that the most of the bonds, inflation-linked bonds, have a real yield of between 4.7 and about 4.9%, right? Now, it's important to note that this bond right there, right, that brown bond there, this one, that one matures in 2033. It's called the R202. And one of the bonds there matures in 2050, and the yield differential between them is about 10 to 20 basis points. So you're being relatively handsomely rewarded for taking on term risk in the linker market out to about 2033, so about 11, 12-year point. Beyond that, not really. And a lot of that has to do with who dominates the linker market, and it's significantly more dominated by pension funds and life insurers specifically that are more structural buyers of linkers than asset managers who are more periodic or opportunistic buyers of linkers. So one of the metrics we look at when judging whether inflation-linked bonds offer value is this. The blue line is our Nelson, Siegel, Svensson, or our smooth bond yield curve. Right? This is where we think bonds should price in South Africa, nominal bonds. And it's fitted using the data from the bond curve. So it's pretty close to where a lot of the bonds are indeed pricing. This red line is the inflation-linked bond curve. And this green line is what's called the break-even rate, right? Or break-even inflation rate. What this line shows is what inflation would need to be over the period of investment to maturity of the bond for the nominal bond and the linker bond to give you the same return. So we know what the nominal bond return is going to be, right? The return is fixed. However, the nominal bond moves around with inflation, and one of the variables is what is inflation forward going to be. If you look at this R197 and the I-2025, you'll see that inflation needs to average between about 4.5% to 3% for these bonds to give you the same rate as the nominal bonds. To put that differently, when the inflation numbers on the break-even rate look reasonable, in line with your expectations or lower than your expectations, then inflation-linked bonds are generally a good buy. If they are higher than your inflation expectations, then you prefer nominals over linkers. So you'll see towards the back end of the curve, inflation needs to average over 7% for the back end bonds to offer value. So we tend to prefer inflation-linked bonds as well, closer towards the front end of the curve, specifically around the 2025 space. But the 210 and the 2029s, both of them are actually offering pretty decent return numbers relative to the nominals. We still, if I were to stack rank my fixed income asset classes, it would be linkers first, nominals second. No, sorry, nominals first, linkers second, and cash third. Right? We have an overweight position to nominal bonds, a neutral position towards linkers, and an underweight position towards cash and credit in most of our multi-asset portfolios. The last slide that I like to show is this one. It just talks to, let's call it the reward for risk. This line here is the one-year cash rate, one-year NCD cash rate. You can see that it's running at an all-time low. This line there is the yield, the real yield on a government bond. In fact, it's the I-2033. So it's about a 12-year inflation-linked bond. Right? So the real yield, which you still need to add inflation to, is currently higher than the nominal rate on a one-year NCD. If you look at the 10-year bond, that's there. So this yield gap that's opened up is completely unknown by historic circumstances. And if you look at some of the other asset classes, this green line, for example, is the forward yield on Growth Point, a consensus according to Bloomberg. And if you add in here preference shares, the preference share yield would be somewhere around there. Also in the 9.5% space. Right? So the gap between cash and your other return generating asset classes is at historic margins. This is one of the reasons we expect that your multi-asset income funds are likely to outperform your cash and money market funds by wider margins than we've seen up until, let's say, the end of 2018. Because in 2018, 2017, and 2016, your one-year cash yield was right here amongst the yields of your other asset classes. So it's probably a good time to consider funds like Ashburton Diversified Income, where you can participate across a broad spectrum of returns. Now, the caveat for that is that historically, many of the multi-asset income funds used a lot of credit and not a lot of other asset classes. In the world in which I've just described, where you overweight other asset classes and significantly underweight cash, you're likely to outperform significantly over the medium term, but you will also see significantly increased volatility to what you were used to in the sector for the last couple of years. That's it from my side. Are there any specific questions from the audience? Anything they didn't cover, you just want me to cover? Please let me know. Doesn't seem like any questions are coming through. Okay. If you have any questions, please contact the BDMs and Ashburton sales and representatives. If you want to have a discussion with me about some of the other things, we can do that. Set up a presentation or discussion on any of the specific portfolios or positioning or any specific other details you may be interested in. Thanks for joining us today, and I hope you have a good weekend. I know it's not Friday yet, but we're almost there. Thank you. Goodbye.